Well, hello everyone. I am Emma Howard-Boyd and I am chair of the Environment Agency here in England. As the environmental regulator, as well as having responsibility for flood and coastal erosion risk management, we cover both climate mitigation and adaptation with a strong focus on increasing the resilience of people, property and businesses to the physical risks of climate shocks, protecting people and the environment and supporting sustainable growth. Following today's earlier sessions on the launch of the OECD's report on managing climate risks and transition processes, I'm delighted to move on to the acceleration and financing of financial protection for resilient infrastructure in the context of post-pandemic recovery. I am pleased to welcome 5 distinguished panelists in this session, each of whom will present their perspectives on the policy challenges, social dimensions and governance considerations on mobilizing finance for resilient infrastructure and to leverage the potential of the public and private sector working together. This session has been organised by the Coalition for Disaster Resilient Infrastructure, INSU Resilience Global Partnership and the Coalition for Climate Resilient Investment, of which I'm one of the co-chairs. I will briefly introduce each of these organisations. So the Coalition for Disaster Resilient Infrastructure is a multi-stakeholder global partnership of national governments, UN agencies and programmes, multilateral development banks and financing mechanisms, the private sector and academic and research institutions. It aims to address the challenges of building resilience into infrastructure systems and infrastructure development by providing technical support to its member countries in developing innovative solutions for financing resilient infrastructure through public-private partnerships and other frameworks of investing. Its partnership with the INSU Resilience Global Partnership and the Coalition for Climate Resilient Investment aims to encourage investments in resilient infrastructure by making a strong economic and financial case of such investments for public and private sectors. As one of its ongoing initiatives, CDRI and its partners have been organising the Disaster Risk Finance Dialogue Series, which culminates in the events here at COP26. The INSU Resilience Global Partnership is an international alliance with over 110 members for the scale-up of climate and disaster risk finance and insurance solutions. Under its Vision 2025, INSU Resilience strives to financially protect 500 million poor and vulnerable people through risk finance solutions by 2025. The partnership promotes pre-arranged, predictable financing on standby when disasters strike, and this supports governments in quickly restoring critical infrastructure services. And the Coalition for Climate Resilient Investment represents the commitment of the global private financial industry in partnership with key private and public institutions to foster the more efficient integration of physical climate risks into investment decision-making. And I know we're going to hear more about each of those initiatives as we continue to speak. So let me introduce my panelists today. Starting on my left, we have Kamal Kishore, Member and Secretary in charge of India's National Disaster Management Authority and the Indian co-chair of the Coalition for Climate Disaster Resilient Infrastructure Executive Committee. And then Dr. Maria Flachsbart, Parliamentary Secretary of State for the Government of Germany. Axel von Trotzenberg, Managing Director of Operations for the World Bank. Online, we have the Honourable Ken Ofori-Atta, Finance Minister of Ghana, who will be joining us virtually. Great to see you online. Great that you can join us through this means. And lastly, but by no means least, John Haley, who is the Chief Executive of Willis Towers Watson. So as I've said, the objective of this session is to discuss global policy perspectives by world leaders on accelerating financing and financial protection for climate and disaster resilient infrastructure in the context of the post-COVID-19 recovery. Investment in infrastructure development has been viewed as an important part of economic recovery following crises, stimulating recovery efforts and resulting in job creation and revitalization of communities. Considering that governments around the world are now planning to invest heavily in infrastructure as part of their recovery from the post-pandemic economic slowdown, it is imperative to ensure that such investments result in an inclusive, green, and resilient recovery. I'm going to move on swiftly to each of our panelists who are going to talk about the role that they are taking and leading on this agenda. It's so important that we understand what is taking place urgently around the world and how we can accelerate the work that we are doing in partnership together. So I'm going to start off by asking Kamal Kishore to give his first comments on this important discussion. Thank you very much.
Thanks very much, Emma, and it's great to be here with colleagues representing very interesting complementary perspectives. So let me start off by saying a few things about what we're trying to do in India in this space, and to an extent that is influenced by the work that we are doing under the Coalition for Disaster Resilient Infrastructure as well. So in the post-pandemic world, I don't know whether we can still call it post-pandemic though, but that's the hope anyway. In the current circumstances when there's a need to revive economies, India, like other countries, is also investing heavily in infrastructure. We're talking about a $1.4 trillion infrastructure pipeline. So what is different this time? I think it is different in three ways. One is that the whole emphasis for the government of India, our Prime Minister, is to really make the infrastructure story people-centric, inclusive. We don't want to count how many thousands of kilometers of road we've built. What we want to count is how many jobs those roads have created, how many people have got better access to markets as a result of that. We really have to keep our eyes on the results, real world results for the people. And if you want to do that, you can't do it sector by sector, asset by asset. So that brings me to the next uniqueness, which is to look at it multi-sectorally. How you look at multiple transportation sectors, investment in rail. We have a large program called Gati Shakti, which is a connectivity infrastructure, but also link that with energy systems, both traditional as well as renewable energy systems, telecom networks, and social infrastructure as well. So that's the second thing. How you make it more intersectorial and look at it in a systemic perspective. And the third thing is, and that is particularly when we want to say that this is going to be resilient, is you need an institutional infrastructure to develop the physical infrastructure. And that institutional infrastructure must have the analytical capacity, and this is the work we are doing with Insure Resilience, the Insurance Development Forum, CCRI. By 2023, we hope to have a global disaster risk data platform which can inform decision-making in infrastructure sectors. So that's the third thing. Build the institutional infrastructure with enough analytical capacity to inform investment in infrastructure so that it can be resilient.
Brilliant. Some fantastic opening comments. I'm now going to hand over to Dr. Maria Flachsbach for your opening comments.
Thank you very much. Let me just briefly paint a picture of the point of view of our country. So we know that the COVID-19 pandemic has shown us the importance of the building resilience at all levels. You just mentioned it, colleague. And as the world slowly recovers from the compact impacts of the pandemic, we must not forget that the climate change crisis had not gone away, it still exists. So we just experienced flooding in the Ahr Valley, and the surrounding area has given Germany a dramatic impression of the impact of climate change. We just didn't believe that it could hit our country so hard as it did. Beyond this devastating impact on households and business in the region and many lives lost, the damage to critical infrastructure was substantial. And the cost of restoring the roadways damaged by this event alone is estimated at 2 billion euros for our country. While Germany will be able to absorb these losses within its fiscal capacity, the overall impact of similar events in developing countries has the potential to be much bigger, with the losses reaching critical dimensions in relation to national budgets and cross-domestic products. So, as we reach a turning point in this global pandemic, we must find opportunities for a green and climate-proof recovery. So every country recovery programs and initiatives need to eliminate incentives to invest in fossil fuel-based developments, drive forward investments in resilient infrastructure, and set up plans in financial strategies for greater disaster preparedness. So the Coalition for Disaster Resilient Infrastructure is a milestone from our point of view initiative that shines a spotlight on this crucial topic. We cannot overcome this global climate change which all of us are facing without making our infrastructure more resilient. And as a co-chair of the high-level consultative group of the Inter-Resilient Global Partnership, I'm particularly pleased to witness the cooperation between the Inter-Resilience and the Coalition for Disaster Resilient Infrastructure, because we started at G7 at the G7 meeting in 2015 in Elmau, and now it is scaled up with a disaster risk finance and insurance initiative. So we are very, very happy to just to go now beyond that of risk financing in making infrastructure resilient. In particular, the significant risk experience of the insurance industry should support risk-informed infrastructure projects from the very beginning. Only by putting all these pieces together, we can succeed in reducing the effects of infrastructure disruptions. And we are looking forward that both of our countries, India and Germany, will even more and stronger work together to reach this aim. Thank you very much.
Thank you, Marianne. And to hear about the costs of your floods, not only in terms of the monetary value, but also the loss of life. I know from my role as chairing the Environment Agency in the UK, how important it is that we start investing to protect lives and livelihoods. Even the flooding that we saw over the weekend in the run-up to COP26, here in Scotland where we are today, but also south of the border in England, in Cumbria, we know that some of the investment that we've made, whilst we still had homes flooded, the investment we made protected over 1,400 homes and buildings in that part of the country. So it's so important that we get in front of the climate change that we're beginning to see. Axel, I'd like to introduce you, invite you to make your opening comments as well.
Thank you, Emma, for the invitation. Pleasure to be here. I think there's good news and there's really bad news. The good news is that I think that there is increased awareness that if we want to do investment, it has to be resilient, but also particularly inclusive. You mentioned that. I think that is extremely important, and basically that infrastructure should be better climate DNA'd. Meaning from the concept in the area. I think there is awareness and everything is. Now the bad news is that the investment needs are massive, particularly in developing countries. The infrastructure gap worldwide is $3 trillion per year, and particularly this recovery is affecting disproportionately poor countries. And one of the issues is then how do we actually help developing countries to not only have the levels of investment infrastructure that they desperately need, but that they are also resilient. And here it is missing. And I think here are the dimensions where we are thinking is first,
we need to make a much greater effort to actually help countries overcome that. Think of also if we are looking at the big challenges in Asia to overcome, for example, the coal exit. The bank estimated that it will cost between $9 and $13 trillion over the next 20 years, and essentially every single day a coal-fired plant would need to be closed. The problem is there are plans for 300 more. So one of the things is if we do this, this is our huge costs are involved, and we need to be aware of that. So that means we need to get the private sector involved in it in a massive scale. And I think there is, again, awareness, but here we need to have regulatory frameworks being adjusted and incentives. And I think here, I think what the coalition is, and I'm happy that the name of the organizer is Coalition Partnership, is nobody can do it alone. We can only do it together, and I think that are the things that we need to have a systematic debate. But also what Germany did today is, for example, with the risk facility that there are 75 million euros being pledged. We need also de-risking and measures. And this is one of the things what is going to be essential is that we need to look, particularly for the poorest country, to also help de-risk the investment and get the private sector in. Now, what can the World Bank do? First on the dimension is, and that is for every organization, every country, is we have to raise the level of ambition. You heard that already in the introductory remark. We need massive investments on this. That means governments, but also international organizations have to step up. What we are going to do is we are going to increase our investments over the last 4 years of about 83 billion to 125 billion for the next 5 years. And that means we need to have, in absolute terms, we need to do it. And secondly, we need to also to see how we can actually then pull in more of the private sector, so de-risking, but also when disaster hits, that you have contingency financing instruments available. That we are doing as well. What it will require is, and I think is the big challenge, is how we get better the private sector. And here, a last word. For the low-income countries, we are mobilizing concessional resources. And that I think that we are succeeding because there is the political support. For the middle-income countries, it's much more difficult. So if you look at the Indias, it will be difficult to mobilize the billions that are necessary to support India on this. And that needs a discussion, because that is how one could help the India, but also Indonesia, to tackle also the difficult issues of coal exit. And that is, I think, a debate that we need to urgently have.
Brilliant. Well, we will be moving on shortly to the private sector. But before we do it's my privilege to ask the Honourable Ken Ofori-Atta, Finance Minister of Ghana, to make some comments. And we're so pleased you're able to join us. If I can call you Ken, virtually. Over to you. Thank you very much.
Thank you very much indeed, and good afternoon to you. Axel, it's good to see you again with your impassioned play for us, and that's always good. And Maria, of course, we've met many times on Africa Development Bank, and Germany has always stood strong for us. So we do appreciate that. I think the evidence that confronts us is that we are really facing this triple crisis of COVID-19, climate change, and the consequential loss in nature. The issues, are certainly global in their reach, but tremendous implications, especially for us in Africa, because of the nature of the development, and really, in a sense, the moral outrage which has come through the way we have tackled the vaccine issue and the nationalism that seemed to have emerged, where really the common good has been trampled on with, I guess, might and try, leading the argument. I mean, but to put it in context, we remain in Africa some 17% of the global population, but by 2050, we should be a quarter of that, for some 850 million youth involved, which will be the largest on the continent. So for us as a society looking at the common good, it poses a real challenge as to what we want to do for a prosperous partnership for the future. And the big question we have is that everybody knows the numbers, that intrinsically we are estimating some 2 trillion needed for infrastructure gap, about 100 billion a year. I think there's an estimate of another 2 trillion for climate change that we have to contend with. And then there's another 425 billion that is required to reverse what has happened because of COVID. But if you look into the pocketbook that we have, we are seeing an either, replenishment effort of less than 100 billion. The SDRs, as you know, Africa got 33 billion, pushing for rechanneling of another 100. And then, of course, the climate change issues, we've been buddying around $100 billion, which has been coming for 11 years also, yet to see that. And then, of course, in the manner in which the climate change rhetoric is going, Africa likely is going to be forced with all sorts of preconditions as we engage the World Bank and IMF going forward, with very little capacity to be able to respond in like manner. So the question that we really need to honestly ask ourselves if we are thinking of people and planet for the future, with this huge population that is a certainty, what are the risks that we are supposed to take today to avoid, maybe a multiplier effect of the resources required? And how differently should we think about the global good and not talk about moral hazards, etc.? I mean, the challenge, Axel, I know a few years ago when I was chair of the development committee, was the corridors of the bank, constantly talking about billions to trillions. And that segues, really into what the private sector can do. And I'm glad that this coalition is looking at that. Because in truth, we have hundreds of trillions of assets under management underperforming, but because of the nature of the construct of our rules, those resources are not able to move, and we have not therefore put our minds to risk mitigants to ensure that the monies are used appropriately. And that is the challenge. So are we ready for carbon tax in the developed countries? And are we really ready for green subsidies for the LDCs so that the e-cars, the forestation, etc., can be done effectively? I mean, you theoretically, you look at a tragedy of Keynesian economics where our interest rates are out of the roof because of an African premium. We therefore are not able to generate the production and therefore consumption and therefore income. And then we, of course, do not have the investment capacity to do that. You know, so you have these three I's of interest, income, and investment that we just do not seem to break through because we are not able to think outside of the box to be able to do with the resources that Africa legitimately has. But by the end of the day, with the pace at which we are going, with richer countries being able to determine where there will be net zero in emissions, you're going to be impoverishing Africa in a way in which it is not necessary. So what is the stimulus that we need to be able to tackle this for global good? And that really becomes, you know, a principal preoccupation that we all should be having if we are to build a stronger world going forward. So I do welcome this. Clearly, even in these 18, 20 months, the World Bank has gone beyond what it normally does. IMF has gone way beyond what she also normally does. So how do we redefine to make it even more relevant for the future is what we are talking about. You know, how do we look at the youth that is going to grow? How do we digitalize our economies? And how do we look at the issue of financing? Because there is enough money around, but siloed in different pockets that we have not put our minds to mitigate the risk and therefore release that for global prosperity. So thank you very much for the opportunity to be on this panel.
Thank you. And Ken, thank you for reminding us all so elegantly and eloquently how this climate change agenda, we can't look at it through silos, that resilience goes absolutely on alongside the net zero agenda, the natural environment, the youth agenda, the just transition. So thank you for those comments, and we'll come back to you shortly with some further questions. It's now John's turn to give us a private sector view, also having been one of the co-chairs of the Coalition for Climate Resilient Investments. So John, over to you. Thank you.
Thanks very much, Emma. And I'm delighted to be part of this important discussion today among some real leaders in the space. And I think my fellow panelists have done a good job of framing the issue that we really have no time to waste in protecting people and economies from the growing impact of climate change. And in fact, they put forth a couple of themes I want to make sure we pick up on in the rest of the discussion, but one of the important ones was collaboration, Camille, that you talked about, and I think that's something that we're absolutely going to need to be successful in attacking this. But one thing I think we know also is that recognition and awareness alone are just not enough to meet this challenge, and so we need real collaboration. And we need an unparalleled level of real collaboration and practical collaboration. And it's got to be between regions, it's got to be between governments, it's got to be between industries, it's got to be between sectors. And so we need to have mechanisms where we can agree on and we can then apply solutions that are coming along. And particularly from the way we think about things at CCRI, where we're focused on resilient investment, what we see is an information failure, and Camille, you talked about analytics. We see an analytical failure. Physical climate risk and the advantage of resilient decision making is just not recognized properly. And it's not recognized properly because we don't have the information and we don't have the analytical tools to do that. And in fact, in many ways, in the investment decision making space, it's worse than not recognized. It's actually penalized. Good resilient investment decision making. And so this is really the tragedy that from our standpoint we all have the obligation to address. We started CCRI about 2 years ago at the UN Climate Week, and what we wanted to do was bring together a coalition of all the necessary parties. And so the necessary parties from our mind included private industry, and about 2/3 of our coalition is made up of private actors. And among the private actors we have there, we have investors. We started with about investors representing about 4 trillion of assets under investment. We're up to a little over 20 trillion now. And we hope to continue to grow that. But investors are important, because if investors are going to insist on the right kind of standards and the right kind of decisions being made, then we know that that's going to happen in practice. We have governments, and we've been working with governments around the world. Particularly, we've done a case study of a national economic prioritization tool with the Jamaican government, which will be rolling out in the next couple of days, and that's something that we've done a lot of testing here, and we think this is going to be applicable to countries around the world. We're going to be rolling it out in more countries coming forward. And then we've worked with multilateral institutions, because the multilateral institutions are important, particularly for the issue of the less developed countries. Because one of the things we want to make sure is there's what we refer to as the risk of pricing risk. As we get better at pricing risk, we don't want that better information to price the less developed countries out of any kind of resilient infrastructure at all. And so we need to make sure we have mechanisms to address that issue also. So with that group, and then we've just had such a terrific partnership with CDRI. I'll just have to say it's great working with your organization. But we're working and our focus is first on the governments, and their efforts are really around the protection of people, nature, and economies from climate change in the long run. And we put that first because, frankly, that's about people's lives and livelihood. And that's the most important thing. But the thing we like about what we're doing here is that there is a convergence of interest, because when we work with governments to do this, we can also work with practical solutions for investors so that we enhance their value to shareholders. And that's that convergence of interest that gives us great hope that we can have some solutions going forward. I mentioned earlier that this is a moment of some urgency, and it clearly is. But I think it's also a moment for some opportunity, because the institutions, and whether the institutions are public or private, that recognize this situation, the institutions that have the vision and the leadership to act now, we think they're going to see their competitiveness enhanced incredibly. And with that, the ability to attract capital to their country, to their organization, that's going to be greatly enhanced. And if we don't seize this opportunity, if we wait too long, we're going to be focusing on minimizing losses. I think that's something none of us want. So a great time for this discussion, and thanks, Emma.
Thank you, John. I'm going to open out now to a round of questions to you all, but I'm just wondering whether you have any quick reactions to what you each have said. I mean, there's a very, very strong common theme about urgency. The Coalition for Climate Resilient Investment was challenged a few weeks ago by the UN Secretary General to start acting at pace. And he gave us targets of numbers of countries that we need to be working with in the near future. I'm really interested in how we start working together, that collaboration that you've all talked about, in a way that each time we come together at events like the COPs, that we can point to not just the theory of what we're trying to do, but the real practical action on the ground that will help countries really make a difference in terms of how they recover and how they grow in the future. So perhaps from each of you, including Ken online, just a quick response to what you've heard from the other panelists. Who'd like to go first? Axel.
Yeah, I would like to a little bit what Ken is saying. I think we need, when we look at private sector involvement, then let's be very concrete in Africa, or so what is needed. The fact is that it's not being stepped up. And private investors, they would like 20% return or so, and then it becomes very, very difficult to do. And so I think there is a need to really focus on this. The mega trends in Africa are dramatic. this is not only demographics, there is also massive infragility. And so we need to really act on this. And I think we have been scaling this now up to 30 billion per year. But I think more needs to be done. It needs to be not only multilateral institutions, bilateral, but private sector, and how we can get this. Because this is ultimately, for example, the energy challenge. Many countries have still very low electrification. You need to get private sector involved. You will need to have energy access. And those investments have to take place. And I think we need to be, I would favor, then let's call it out. We have had a lot of talk on the private sector involvement, but I don't see the investment because maybe we take it in the aggregate, and then the Mexicos are taken into account. Then, but I think the test is in low-income countries, are we meeting the test? In lower middle-income countries, are we meeting the test? And there are the difficulties, and I think we should have there the discussion.
Thank you. Who'd like to come in next? Kamal, I can see.
I think I'll take off from what John was saying a few minutes ago, and that points to a public policy challenge and an analytics challenge. So quotable quote today is that investment in resilience sometimes gets penalized. I think it's a very serious comment you're making on the state of affairs. And why does that happen? That happens because when governments procure infrastructure, they look at immediate costs and not the life cycle costs. So how do we reset public policy so that life cycle cost, what would this infrastructure service cost over 60 years, as opposed to what would it cost in the next 5 years? So how do we do that public policy reset? But if we were to do that, do we have the analytics to support that? This year in India, we've had a below normal monsoon, and we've had some of the worst climate. We've seen more cyclones this year on the west coast than on the east coast. In the last 10 years, most of the cyclone risk mitigation programming, some with the bank's help, is on the east coast because that's what we've been used to. But past is no longer a good guide for the future. So how do we turn that into solid analytics? And that is a challenge which is to be grappled not just by developing countries, but the whole world. We don't know enough about how do we manage uncertainty. We are good risk managers, but not good enough uncertainty managers.
Maybe I could just pick up on that too. I agree with everything you said there, Camille. And in fact, there is a model in the insurance industry for a way we might think about tackling this analytical challenge. The global insurance industry was rocked by the presence of a number of earthquakes in the early 1990s, and they were things that there were no good analytical models for. And they came together and created this global earthquake initiative and developed open source transparent models for earthquakes. And these models were actually quite good, and that's not something, we still get earthquakes, but the provisions for them are set aside the proper way. And I think the way we need to tackle this, this public policy thing, because you're absolutely right about governments look, and we hear this from our CCRI members, when governments are investing in infrastructure, they look for the least expensive cost. And it reminds me of Oscar Wilde's comments about a cynic knows the value of the price of everything and the value of nothing. And in infrastructure, I sometimes think we focus on the price of everything and the value of nothing there too. But what we're working with at CCRI is to develop these models, but also to develop among investors an agreement about what the standards are, to develop among the rating agencies agreements about how they will rate the bonds that are being used for projects, et cetera, for them to be up to the resilience standards. We're building the physical climate risk models to be doing this, and we're working with the Insurance Development Forum on this global resilience index. So there is a lot of work. I think I talked about the information and analytical failure in the beginning, But I don't think that's something that we're doomed to have forever. I think we have the capabilities to do it, and I think we have the will now, and we're coming together to do that. So to my mind, that's very exciting. Could I just say one other quick thing that, Maria, something you said resonated with me when you said that people thought these floods couldn't happen in our country. And so I live in Miami, and there was a lot in the news about a condo that collapsed, a couple months ago there. And I was thinking about that in the context of the climate, because it was a similar thing. These people understood, I mean, the condo board understood that there was a great risk from this, and they just didn't want to spend the money to do it. And that was for their own building. But it's that kind of mindset that we need to attack, and we need to recognize that that's out there.
I couldn't agree more. This is so important that we understand that this danger is real, and that it can come to us, and not only to and I have to apologize to people in the global south, to India, to Ghana, or to everybody else. That is so important. It is a thing about the whole planet. And so if we have understood that, we could react and we could act. And there is another point. We have to invest in resilience, because even if we reach the aim, the target of 1.5 degrees, the danger is real, and these disasters will happen. And so we have just to think about how to minimize the consequences of these disasters. So this is a new point we have to understand, and we have to start and go into future. And there is perhaps two other points I would like to mention as somebody coming from Germany and from other developed countries. We have to show, we have to demonstrate that both is possible. Wealth and decarbonizing. This is very, very important, because people from the global south, they will not follow us. They always tell us and tell me what you are saying, what you are telling us. We want to get. We are on the way to this wealth. You just have and you ground and you found your wealthiness on coal and on oil. And so you just now forbid us just going the same way. This is another big issue we have just to think about. We try in Germany just to be a sort of authentic. We just have strengthened our goals, reaching this 1.5 target, and of course we try to take responsibility by investing in a global climate saving mechanism, and so we promised, and we just do it. This is our point at the moment. Thank you.
Thank you, and I'm very keen to bring in Ken in a couple of seconds, but Maria, I just wanted to reflect on a decision that we made as the Environment Agency Board when we recently had a presentation about what would have happened in England had the same events that you experienced in Germany and Belgium happened in the UK. And we were about to publish, as we need to do every 3 years, set out in the Climate Change Act, an adaptation report. And the presentation we had from our frontline colleagues made it very, very clear that despite all the investment the UK government has put into flood work over recent years, if the same sort of weather hit the UK, we would be at serious risk of a similar sort of event. And that, I'm not sure whether inspired is the right word, but it motivated me to, when we published that report, to call out adapt or die, and to learn from what has happened around the world, that this is so much, this is happening everywhere, and it is really affecting lives and livelihoods. And on that point, I'd like to bring you in again, Ken, for your reflections on what you've just heard. You talked about moral outrage in your opening statement. And again, we need to collaborate to deliver real change on the ground. What your response on what you've been hearing from the panel? Thank you.
Yeah, thank you very much. You know, I mean, as finance ministers in Africa, this COVID experience has brought us together a lot more than, you know, we used to have discussions. And for example, philosophically, we have moved from thinking of healthcare as a consumption variable into an investment category. And that's a major shift in the realization of this whole build-up and the issue of saving lives and building for the future. So that's important. I think that the real challenge as we speak, it's are we able to agree on how Africa is part of this whole common humanity? Because I mean, when you listen to Maria, she's very clear about the need, about the argument of equity. That how do you build your GDPs for $30,000 per capita, and we are $2,000, and suddenly the issue of 1.5 degrees centigrade is important for all of us globally, and somehow we have to pay our way through it, and with a clear recognition of the costs, and still talking about solutions within the 100 billion bucket, and various civil servants feeling quite generous that this is a remarkable contribution to the solution of absolute inequity and social injustice. And the issue of almost the beginning of a normalization of such an apocalyptic event that we are all going through quite a bit of trauma for. So we strain to understand what this new world of people and planet is about, and whether there's a genuine commitment to really look at, you know, our whole 70-year financial architecture, and admit that it has deep weaknesses if we are to create a world in which it will be safer, better, and more sustainable for all of us. Because as she said, yes, you could push towards the 1.5 degrees, but how do you sustain that if we don't have a global financial architecture that would support that? And as Axel mentioned, there really is enough resources around if we can bring the private sector to the table and find ways of protecting that money, but making sure that resource works for us. I mean, the insurance industry, for example, with due reference to our colleague here, you know, tax, you know, maybe some 6 or 7 percentage points to anything that is African. And then also when we go to the market, you know, I may pay 600-800 basis points beyond Greece, with not much of a flattering credit for Greece, but a geography which somehow then enables them to save $2 billion a year, which I may have to pay for 20 years. So really all of us sitting here is asking, I mean, are we really doing Africa a favor? Or is this a common good that the minds around the table, we can truly and genuinely solve, and not just talk about it, because it's expensive. The sense of dignity is eroded. Our common humanity is questioned, and therefore have individual leaders who may be helpful in a season, but the structure has not changed. So where is that body that worked on the financial architecture 70 years ago, so that we can really look at it and be more prepared for the inevitable crises that are due to reoccur. So it's a challenge for us, and I think we need to be shouting on top of the steeple to really sit down, recalibrate how we think, the variables we use, and acknowledge that there's been a massive policy failure on the global level. Thank you very much.
Thank you. And one of the big themes of this year's COP is finance and how we get more finance focused on the climate change agenda. I think we'd recognise that a lot of that is focused on net zero, but I think what we've all said in this room, that you need to be making sure that that net zero transition finance is resilient for the climate change that is already locked in the system. We've got this sense of pace and a system that has been built on old structures. So perhaps some reflections now on what you can do within your countries to make those changes so that this decade that everyone is calling the decade of real difference, of delivery, is also taking proper account of the climate change that's locked in the system, and the way we are collaborating will really help not just help everybody become more resilient and shift, if we can, the conversation from risk to opportunity. Maria, you want to come in?
Yeah, I just want like to answer very briefly. You know, you're completely right. Finance is one of the big questions and at the top of the agenda, and no question to Ghana as well. But it's not only the question of just increasing money and more money, but it's the question of how investing in an intelligent way, you know, in a way where it changes things. Germany, for example, I would like to mention it very friendly. Between 2014 and 2019, we doubled our contributions to international climate finance systems from four now to 5, and then the Chancellor promised to 6 billion euros. That is not it's not too much, but it's also not too less. It's quite nice for a strong country with a strong economy like we have. We just invested even on top 75 million euros on top to CRIF. So we try what we can, but now we have to think about how to invest in an intelligent way. We discussed about the question of resilience, of investing in resilient structures. We have even more to discuss the question of insurance. I think this is very important in this context. So the way we did this cooperation between India and Germany could be another instrument just for more intelligent investing model, and not only more, but more intelligent. Thank you.
Brilliant. Kamal, would you like to come in with some reflections?
Well, I mean, money is never enough. And of course, the question has to be asked about how do you count that $100 billion per year that was basic services, whatever, in a sustained way? And how do you make a public policy case for sustainable or sustained delivery of services to people who have never had those services? So I think it's also that, and in that, I would agree with Finance Minister, this siloed finance, it happens at the global level, but it also happens at the national level. It also happens at the local level. So we are very good at coming up with projects which are very neat, very efficient, but convergence, which is a difficult task, it also requires imagination. We are often found wanting on that. So I think I would agree that let's continue to talk about more funding, but also
How
make a
funding?
case for more imagination in using what we have in a manner that builds resilience.
And we know in England, for every home that is flooded, 16 other people are affected by the infrastructure services that they use. I also know from the last time I looked at the figures in the UK, for the annual 1 billion that goes towards flood defences and the flood programme, there's probably 39 billion pounds worth of other infrastructure spending. And we need to make sure that as that continues, and the figures will undoubtedly change, those are a couple of years out of date, but all of that infrastructure is thinking about net zero. All of that new infrastructure is thinking about resilience, and all of that infrastructure is thinking about nature and nature's recovery. And so it is about a different way of thinking. So Axel, to you and the World Bank, and I know you've made some changes there, but again, some of the figures that I've looked at historically show that whether it's public funds or private funds, the focus on adaptation and resilience has been a small percentage. It's not about 50-50, it's about integrating the way we look at these issues.
That's correct. And also, when we talk about the investment, we should also talk about the benefits. Because we calculate if you do a dollar invested in climate resilient infrastructure, that yield benefits, namely of avoiding. And that we calculate it's a 1-to-4 relationship. Also, I think we need still to keep in mind, when we are talking about the 100 billion that has always been done, that is about between 0.2 and 0.25% of the GDP of OECD countries. So let's keep the dimensions on this. Having said that, we need to think on how you can better leverage it. I'm saying this, and it's not because only the World Bank, it's also the regional developments, European Investment Bank. The fantastic idea in the 40s when they started with the World Bank was the leveraging capability of multilateral institutions. You pay very little into these institutions in capital, and you get a huge lending program. In the case of the World Banks, in 75 years, only 20 billion was paid in, yet there was a program of 800 billion. So if you do that for climate, you put 10 billion, you can get, over the next 10 years, a program of 100 billion. Think of this, if you do that with the Regional Development Bank, the Asian Development Bank, you do the European Investment Bank, you get enormous leverage, and I think you can get to the 100 billion much quicker if you mobilize that leveraging capability on this, but you have to think differently. Previously, you gave it for all over the development thing is, now you may need to be much more focused on the whole adaptation and mitigation agenda. So I think that is one. I think same on, we need to think about insurance, you mentioned that. I think for the low-income countries, our experience is as long as the premium is paid by donors, you do it. I have seen a couple of experiences in Africa. I've seen it in the Pacific. As soon as this money stops, the programs stop. So one of the things is, it is also, let's keep in mind, and Ken gave also a reminder, is the pressures on these countries is enormous, not only with demographics, jobs, etc. So everything is an add-on, and they simply don't have the resources. So it is becoming also very difficult. So we need to think, if we want to have these instruments, we have long-term commitments to make. Then one last idea, and I've been more intrigued, is don't we need to think of ultra-long financing, particularly of coal exit? And I'm always keeping in mind, since you are from the UK, after the Second World War, the British government negotiated with the US government a loan that was actually repaid only in 2008. So that from 1945 to, and basically it helped also for the whole reconstruction of a country. If we have these challenges, don't we need to start thinking of ultra-long financing? Because it is not that, you know, for the energy challenges, you cannot solve that in 5 years. You need extremely long, maybe a time, because it is a generational issue. And I think we may need to think much more on how we can actually also, when we say 2050 is our goal, then maybe we need to have also financing plans over 2050, 2060. And mind you, when I think Ken was mentioning Greece. Greece is restructuring ultimately was 2060. So they restructured the debt over very, very long periods of time. And that are the type of things we need to start thinking in a much, much longer period. And that may actually give then a fighting chance to succeed a little bit.
Fascinating idea. And to Kamal, your point about a crisis of imagination, we do need to start imagining, or perhaps borrowing from the past, ideas that have worked. So,
and
John,
the willingness to act on that.
Absolutely. John, your reflections, particularly from the insurance world as well as the private sector world.
Sure. Thanks, Emma. So first of all, I think I'd second what Axel said about, I think we need to think about innovative approaches to financing, whether it's long-term finance or others. This is a crisis and a sense of urgency around this that requires that we just think outside the box a little bit about what can and can't be done. In terms of like just infrastructure needs, there's the Global Infrastructure Hub, actually one of our CCRI members. They came out with $3.7 trillion annually in investment needs. And if you think about what we've talked about here earlier today, which is that resilience, which has costs, isn't properly reflected, it's probably more than $3.7 trillion. You make a case that it's a good bit more than that. And actually, you quoted the 1 in 4, the return of 4 to 1 for investment and restructure. I mean, maybe just an example of what that means in practical terms. I think about the hurricane that hit Puerto Rico and destroyed 75% of the country. You'd be talking about, certainly damage, but nowhere near that. That's people's lives saved. That's people's livelihood saved. That's a country that was devastated for a year or more. And so in real terms, this is something that, this is why we have a sense of urgency about what we need to do. And I think we need to try to find different ways to bring that money in and to attract it to countries. And let me just, insurance has come up a lot. I think there's some, I think insurance can be a big help in certain of these areas. I think one thing that I would suggest, though, is if the donors are paying all of the insurance, that's maybe not the best model. I like a model where there's, and particularly over time, there's a bit of a shift away from the donors paying as much of it. Because insurance is actually, particularly if it's paid maybe on a parametric basis where it's just paid out. We're the broker for the African Drought Relief Consortium. We're the broker for the Caribbean Hurricane Relief Fund and things like that. And they're paid out and the money gets there very quickly. It gets there much faster than aid. Yeah. And that's why insurance... Yeah, that's what's so good about insurance. But one of the other things I think that we should recognize about insurance is if you're paying some part of the premium yourself, you're getting market signals about what you should do. It encourages it to invest in resilience in a way that you wouldn't otherwise. And that's why I say I think some sort of, it doesn't have to be much, but it's actually better if it increases over time if we can do that. That's what we should be looking at.
Fantastic. So we've got
You wanted to come
Ken.
in?
Did you want to come in? Sorry, I didn't see you waving your hand. Did you want to come in now? Thank you.
Yeah, no, thank you very much. I mean, I was kind of listening to Axel, and when we came into government in 2017 and looked at the state in which we were in and the headwinds we had, of looking at our revenue, expenditure, our sort of constitutional mandate for certain statutory funds, the debt, and then the wage portfolio. All of these had to be looked at. And really, as former investment bankers, a couple of us at the ministry figured, that this is a case for elongation of the maturity, and began to talk about the issue of century bonds to give that space for you to recalibrate, to be able to move forward. And really, the rating agencies, sort of reacted so negatively to it. And you get into this rut of dealing with what you have, which leads to exacerbating the situation. And it's important, therefore, for the Washington speak to now begin, to contemplate, these as, really good ways for Africa to also adopt, because it is being done for the Greeces and Brazils and Argentinas when they fall into that. So the discriminatory use of theory for the continent has also not been very helpful, cloaked under moral hazard and governance, etc. Whilst we know that strong interventions with governance issues could break us out of this mess and ensure that we pay our way, because we truly have enough resources to be able to pay our way if we get rid of these albatrosses that have long been assumed to be the only way to manage Africa going forward. But I keep telling the IMF that there shouldn't be any interest in having 54 countries as their clients. They don't have the capacity to do that. But the solutions that they come up with, identifying that, quote unquote, there's a certain stimulus or injection needed, and then how to manage that intervention in a different way, so that it is owned and progressive and really emancipates the resources that we have. So the new thinking is needed, and really, if the historical numbers, as Axel has mentioned, that a $1 investment could yield $4. Why is that not being factored in strongly, so that we take the risk of bringing that appropriate $1 in to move this agenda in the right way? Yeah. Thank you.
Thank you, Minister. So I'm going to take a final round of comments from each of our panelists. Here we are in the German pavilion on day one of COP26. It's really encouraging that we're already talking about adaptation and resilience, but we've heard from each of you about the change that is required to make sure that this sits properly as it should be, alongside all of the focus on our net zero commitments. So as we build that drumbeat day by day throughout the next 2 weeks, we know it's next Monday that we come to Adaptation and Resilience Day, loss and damage, with a loss and damage also there. What are the messages we all need to be taking with us into all the events that we will be speaking at, which show the new way of collaborating and thinking differently, so that we deliver real adaptation and resilience on the ground all the way around the world? Kamal, would you like to go first? Your final comments.
Thank you. I think one aspect I wonder is that while we talk about resilience and resilience matrix, for the public discourse, we've not been able to make it come alive and raise the ambition for adaptation as much as we do for mitigation. Let me give some examples. Can we have this target that by 2030, all the cyclone, typhoon, hurricane prone areas of the world, and they're finite, will have less than 3 days of disruption from extreme wind events? That's a measurable thing. It's entirely doable. We have the wherewithal, and similar things, one can come up with 10 such, deliverables on resilience, and then, you go to your public and say that this is why your electricity systems are going to cost 10% more, because remember, 10 years ago, the electricity used to go off for a month. Now it never goes off for more than 3 days. So if we made it really come alive like that, then we are having a serious public discussion, because it's not just a discussion that has to be had among policy wonks. It has to be had with people.
Wonderful. Maria, over to you.
Absolutely right. Thank you very much for this very interesting idea. Let me step back a little bit, and because I want to mention the OECD study we launched today, some hours ago, which was financed by Germany in order to put this question of resilience, this question of losses and damages on the top of the international agenda, on the top of the agenda of this COP26, because we think that it is very, very important to have a new start, a new beginning of this discussion, leaving the silos, but going and joining and trying to find new solutions with intelligent instruments of financing this. We as Germany hope to take our responsibility. We stand at the side of our partners in times of COVID-19. But on the other hand, we really try to get in good discussions about things like these inter-resilience partnerships. Thank you very much for mentioning all the things which we try to enhance and try to get forward with, because those who are insured, they have to get interested in prevention, for example. They should know that help is coming very quickly, so that the consequences of a damage is not even increasing by waiting for help. So these are the points we would like just to discuss even more than looking only on this goal, on this target of 100 billion euros or dollars, doesn't matter. We think that this is not the solution of this problem, but thinking ahead of this. Thank you.
Thank you, Maria. Axel.
Well, I've twice managed programs in the IDA replenishments. I did the capital increase, and I managed the whole portfolio of trust funds. I think what is required is that if we want to make progress, we need to be real. And we need to know if we're talking about real money, about counting money. There is too much talk about it. I think we need to have a stricter system where we have higher accountability, looking what are the announcements, what are the deliverables.
Could you use your microphone? Sorry, Axel. Thank you.
So what I'm arguing is we need higher accountability. Countries, organizations have to put it on table. What are you delivering? And then what did you promise and what is delivered on an annual basis? I think that is very, very important. Secondly, I like what you said, that we need to move away from maybe from input-oriented finance, or what you say, to output, because ultimately it will affect communities. And so we need to really see how we can make a difference on this. And I think then, I think we need also strategic discussions on how we would like to employ this. I mean, think of this in Africa. I think what my expectation is, only from our concessional resources, 2/3 will go to Africa. That is in about $60-70 billion in the next 3 years. And of that, 35% is going to be climate related. What are the kind of investment that we need? How can we attract the private sector on this? And I would say what we need to keep in mind, Africa has been badly hit because of the COVID. Let's learn from this. When the crisis hit, people marginalize Africa. And I think that this is the strongest reminder in this year. This is totally unacceptable what has happened. The risk is this is also going to happen with climate. So I think we should learn of this, that there has to be a very clear commitment that in order to avoid that not only the promises have to be, but it has to be accountable, and we need to look at it, how to make it happen. Because I think this is coming back to the organization, organizing. This is about partners in a coalition. And it cannot be a coalition minus a continent. Unacceptable. And I think that is the biggest challenge that we are having to put ourselves in it. And quite frankly, the resources that Africa need are multiple what maybe IDA can do, and we need to have that private and public and concessional.
Axel, thank you. A really strong call for action and delivery there. Minister, Ken, over to you again for your final comments.
For this opportunity, and really thank you for the comments, because I think we are all moving in a certain direction, which is really positive. And the challenge really, as Axel has put it, if we don't bend this arch for Africa, it's going to be very difficult for the world to feel any sense of a common humanity and the moral direction in which we go. But it is also really, in the end, a good economics if we can put our minds to it, because this is not an insoluble issue. It's really just a calcification of mindset, which is not enabling us to look at this differently. And so I really look forward to such spirited engagements, getting a coalition of the willing to really examine the solutions of governance, the outputs that we expect, an honest truth about what we are freezing when we are going to strand a lot of resources for the continent. What can digitalization do for the continent, and how do we pay for it so that we free up the resources to be used for a resilient world? We have 1.3 billion people who, in a sense, could be eagles flying, and chickens, clucking on the ground. And we can unleash such potential that I think is incumbent on us as leaders to begin to think differently. These issues about, I think I've counted 300 billions, one for SDRs, one for climate change, and then I think there's a third one. So where are these numbers coming from when we know that the quantum is so much larger? And the challenge of bringing really the elephant in the room, the private sector on board to protect their assets but make sure that the flow of funds enables us to break through this vicious cycle. I think it's hopeful, and we're going to continue to engage and collaborate and make sure that we do our bit for the 1.5 degrees, because it affects us enormously. Thank you.
Thank you, Ken, and thanks for presenting it in such a compelling and considered way as well. John, your final comments.
Thanks very much, Emma. And so, fascinating discussion. I think we talked a lot about innovation and things, and actually, you talked about it. I might just mention one thing, and this is just a small corner of the resilience world, but you know, when coral reefs have bleaching events, the whole reef isn't destroyed at once. It's maybe 30 or 50%, and the reef can be rehabilitated. And a few years ago, we at Willis Towers Watson started this global reef insurance facility, so that we identified insurable interest. Maybe it's a group of hotels off the coast of the reef or something. They could invest in that, and then they can use the insurance for the rehabilitation, which oftentimes involves just paying farmers not to fish there. I mean, fishermen not to fish there. So there's things like that, your long-term financing. These are what we need to be reaching out, and we need to be just thinking about solutions that don't exist now, and inventing some new ones, and we need to bring the best brains we can to do that. Axel, you talked about commitments needing to be real. I think, Ken, you mentioned that too. Totally agree. Commitments also need to be proportional to the competencies from all sides. So whether it's a government actor, international organization, investor, they each have unique capabilities, they each have unique instruments, they each have unique capital. We need to make sure we're getting things that make sense for them. But if we can get this combination of public capital, of private capital, and of concessional capital, along with the right kind of policy incentives, and you know, my belief is if you build the right incentives, the right kind of thing is going to happen. And Ken, you said this is a matter of good economics. I couldn't agree more. If we just design this right and we have the right kind of incentives, I think we can get to the right answer. There's trillions of dollars that are going to be invested in infrastructure, and I think it's our job to make sure it's all in resilient infrastructure.
Thank you. So I'm just going to make a couple of closing remarks before we finish. I think this has been a hugely important discussion right at the start of COP26. I think between us, our commitment is to continue to speak loudly about the importance of collaboration on resilient investment, to integrate it with our thinking around net zero investment, to make sure we shift our thinking as well, whether it's to the long term or whether it's to output finance. So by 2030, that fantastic idea, and there must be other ways of expressing it, so that in the way that our colleagues who are perhaps more focused on racing to zero understand what the race to resilience will also bring, and how we bring it collectively to life, so that the general public see how important it is that we are all striving towards a resilient world. And I think we all will be banging on that drumbeat and be wanting to come back in some shape or form next time we come together at a COP to show how we have actually started delivering real action on the ground. So thank you to our audience. Thank you to the German Pavilion for hosting this discussion. And let's continue to talk about the action that is required now on this agenda. Thank you very much to you, Ken, for joining us as well.
Thank you very much.
Over and out. Bye-bye.